Hello everyone, my name is Eileen Inagal, third year management accounting students. So I am here today to for bookkeeping NC3 review. So this is the continuation of the definition of terms. Corporation. Corporation is a form of doing business pursuant to a charter granted by the government. So corporation is a legal form of business that is separate from its owner. Corporations enjoy most of the rights and responsibilities that individuals possess. They can enter contracts, loans, borrow money, or hire employees, own assets, and pay taxes. So next is credit. Credit means an entry to the right-hand side of an account. Entry on the right side of a double entry bookkeeping system that represents the reduction of an asset or expense or the addition to a liability or revenue. So, credit is an entry made on the right side of an account. It either increases equity, liability, or revenue accounts or increases an asset or expense account. So, for example, you purchase a new computer. So, record the corresponding credit for the purchase of a new computer by crediting your expense account. Next is debit. Debit means an entry to the left-hand side of an account. Entry on the left side of a double entry bookkeeping system that represents the addition of an asset or expense or the reduction to a liability or revenue. So debit is an entry made on the left side of an account. It either increases an asset or expense account or decreases liability or revenue account. So, like for example, so you purchase a new computer. So, you would debit the purchase of a new computer by entering the asset gain on the left side of your asset account. So debit and credit are equal but opposite entries in your books. So if a debit increases an account, so usually you will decrease the opposite accounts with a credit. Next is depreciation. Depreciation is the process of allocating the cost of property, plant, and equipment assets to the periods that will benefit from its use. So, depreciation is an account represents how much of an asset's value has been used up. So, it also happens when assets lose value over time until the value of the assets becomes zero. Depreciation can happen to fixed assets including office equipment, computer, machinery, buildings, and so on. Dividend income. Dividend income is income received from ownership shares in a corporation. A dividend is a distribution to a corporation's stockholders, usually in cash. So, dividend income is a reward given to shareholders who have invested in a company's equity, usually originating from the company's net profit. Next is documents. Documents are basis of recording transactions in bookkeeping. This may include but not limited to sales, invoice, and official receipts. Documents in the accounting industry. Source documents include receipts, bills, invoices, statements, checks, or anything that documents a transaction. Anytime a business spends or receives money, a source document is created. Drawing. Drawing is when a business proprietor draws money for personal needs. So, um, these are withdrawals made by business owners for personal use rather than company use. Next is equity. Equity represents the residual claims of owners. Equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. So to get the equity, the calculation of equity is a company's total assets minus its total liabilities. Then, expenses. Expenses represent the outflow of assets or increases in liabilities due to a company's operating activities. Expenses, it is the money spent or cost incurred by a business and their effort to generate revenues. Financial statements. Financial statements report the business activities during the year and the financial condition at the end of the year. It is also the presentation of financial data, including balance sheets, income statement, and statement of cash flow, or any supporting statement that is intended to communicate an entity's financial position at a point in time and its results of operations for a period then ended. So it is well explained here, so I will explain it further. Next is Generally Accepted Accounting Standards or GAAP. GAAP determine what to record, when to record, and amount to record. It is also the rules and procedures necessary to define accepted accounting practice at a particular time. GAAP also GAAP are a set of rules that encompass the details, complexities, and legalities of business and corporate accounting. Then, General Journal. General Journal is the most basic of journals. It is a chronological list of transactions. So, General Journal is a journal entry. What I mean, a journal entry is the first step of the accounting or bookkeeping system. I mean process, and in this step, all the accounting transactions are recorded in General Journal in chronological order. So it have a specified format which includes the date of transaction, ledger, accounts involved, amount of transactions, and a brief narration to describe the transaction. So, next is General Ledger. General Ledger is the collection of all asset, liability, owner's equity, revenue, and expense accounts. This is a book of accounts in which data from transactions recorded in journals are posted and thereby classified and summarized. It is also called ledger. So, general ledger transactions that first appear in the journals are subsequently posted in general ledger accounts. Then, account balances are calculated and transferred from the general ledger to a trial balance before appearing on the company's official financial statements. And next is income. Income is the inflow of revenue during a period of time. Um, this also this is also the money received by a person or organization because of effort or work or from return on investments. So it is well explained here, so I will not explain it further. Income statement. Income statement shows the components of net income in detail. It is the summary of the effect of revenues and expenses over a period of time. So, income statement, to get income statement, so calculate the net income of a company by subtracting total expenses from total income. So it is important as it shows the overall profitability of a company. Next is income taxes payable. Income taxes payable is income taxes due, including current portion of deferred taxes. So, so it is also a term given to a business organization's tax liability to government where it operates. So next is interest income. Interest income includes amounts from interest on all interest-bearing deposits and accounts. So interest income is the amount paid to an entity for lending its money or letting another entity use its funds. A very its funds. So a very simple example of interest income that happens every day is when an individual deposits money into a savings account and decides to leave it untouched for several months or years. So the money won't just sit idly in his account because the bank will use it to lend money to borrowers. Internal control. Internal control is the process designed to provide reasonable assurance regarding achievement of various management objectives such as the reliability of financial reports. So, financial controls are the mechanisms, rules, and procedures implemented by a company to ensure the integrity of financial and accounting information, promote accountability, and prevent fraud. Inventories. Inventories are products on hand for sale to customers. Inventories is all the goods, items, and materials purchased or manufactured by a business for selling. So next is journal. Journal is a book where all transactions are initially recorded. It is also named the book of original entry from when transactions were written in a journal prior to manually posting them to the accounts in the general ledger or subsidiary ledger.